everyone. Welcome to the show. I'm your host, Caitlin Cormier. It is said that simplicity may be the ultimate sophistication, and that one appeal of index investing for long-term investors who like to take a more hands-off approach to their portfolio. An index investor buys funds that mirror a broader market index in hopes of capturing a similar return. No stock picking required. Sounds simple enough, right? Well, it can be, but that doesn't mean that it's easy. There are mistakes that investors may make that can throw their index investing plan off course. So we're going to identify some of those pitfalls and some ways to help avoid falling into them. Joining us is John Robertson, author of The Value of Simple. He also produces investing educational videos on his website by the same name. John, thanks so much for taking the time to chat.
Hi, thanks for having me.
Okay, so how did you actually get started in kind of the content creation scope of personal finance and DIY investing?
Well, I started doing it for myself and then slowly helping people one-on-one who were near me, friends and family members who needed to learn how to invest because investing is an important skill. And then I quickly realized that this is a gap that lots of people have, this gap of knowledge of actually how to go about investing and sometimes that they should be investing at all. And I started writing about it on my website. I've had blogs going since before blog was a term. So my blog just evolved over the years from talking about video games and movies to talking mostly about investing in personal finances, and then eventually found that there was a need for a nice self-contained resource on investing that turned into my book and then expanded that into the online course.
So it sounds like you're definitely a good person to have in their back pocket for somebody who's looking for these questions, and very generous of you to turn that into kind of a side gig. Before we get into our conversation, I have a trivia question for our audience. According to research by Standard & Poor's, what percentage of actively managed Canadian equity funds underperformed the benchmark S&P TSX Composite Index in the 10 years between June 30th, 2012 and June 30th, 2022? Stick around till the end of our chat and we're going to reveal the answer. Okay, John, let's get into our conversation. You are a big believer in keeping things simple as a DIY investor.
That's
What do you feel are the potential benefits of taking that approach?
the biggest benefit with making things simple is that if your plan is simple, it's a lot easier to actually follow your plan because there can sometimes be a mismatch if someone has a very complicated plan to actually follow that plan over the course of a very long period of time because your whole investing career might be 50, 60 years. Between saving up during your working years and then living off of your investments into retirement. That's a very long time for something to go wrong. And the fewer things that there are to potentially go wrong, the less likely it is that you're going to have something go wrong, the more likely you're going to be successfully following your plan.
All of us living life every day, we always know that there's curveballs that can be thrown at us out of nowhere. So that makes sense. That makes a lot of sense. So you have some golden rules that you have for keeping the investment plan simple. So tell us about what those are.
Well, basically, to keep an investment plan simple, you want to have as few moving parts as possible. So you want to have a very well-defined set of investment products. So if you're going to be investing in something, try to have a set of products that matches whatever the investor's plan is. And then if those can be a very limited number, then it's a little bit easier to track them and to build the plan around them. And then also you want those products ideally to be low cost and very understandable. So one way is with index investing where you're following an index, and that's going to be usually inherently low cost because that's the main appeal of these products, and also very simple because they're going to be following a index. Now that doesn't necessarily mean that they are overly simple because there's a lot of hidden complexity, and that's also a thing that I love is that the investing plan can be complex under the surface, but the more that's hidden and automated, usually the better. And then also you want your plan to be actionable or actually investable. So if your plan involves a lot of perhaps simple heuristics, but then that involves a lot of planning around many different individual securities, many different individual sectors that you have to do a lot of research on, that can be very overwhelming.
So your belief in keeping things simple led you to index investing specifically. You talked a little bit about that, about, how it's based on an underlying index, how it's low cost. Can you give us a quick overview of how investing with indexes works and why you feel that it is simple?
Well, basically with an index fund, you have a overarching index, and that can be a number of different things. That can be a bond index, it can be a stock index, and there are multiple different stock indexes. So there's the Canadian equity market, and that you can build that a couple of different ways, but generally you want to own a whole bunch of stocks and a whole bunch of bonds and to diversify broadly. That's generally our goal with investing is diversify broadly and try to meet some sort of objective to get your funds invested so that you can meet your long-term goals. And index investing helps us do that very simply because if I want to invest in a mix of Canadian equities, US equities, international equities, and some bonds, I can do that with four very simple indexes to follow. And I might even be able to find a product that does all of them in a single product. So that's the first part of index investing and what makes it so simple. And then within that, there's broad diversification. So if I'm looking to invest in a group of Canadian equities, I might want to invest in 300 or so that get picked out and averaged across a number so that when there is one or two really good winners, they are more likely to be in that nice pile for me. And the average return across all of those, I will get that average return less a very small fee. I don't have to hope that I pick the right ones to be able to get a decent stock return over the long term.
I'm going to take a quick pause in our conversation to answer a question that I'm sure is on the minds of some of our viewers. How can I actually find index funds to consider within WebBroker? So let's dive into the platform to see how it's done.
All right, so to find those index ETFs, we're going to click on Research. Over under Tools, we're going to click on Screeners. Once we get to this page, we're going to navigate here to the ETFs tab specifically so we can create a custom screen over on the right-hand side. Now, once we get here, we're going to choose some different criteria kind of to really focus in on the types of ETFs that we're looking for. Again, those index ETFs. So under overview here, we're going to go ahead and choose index and click to add criteria. As we scroll down, we'll see the criteria here. We want to click show index fund only. We're going to choose country, click add criteria, and Canada only. We are also going to choose management expense ratio. So in this case, again, we're just choosing some different things to narrow down the number of results. So we'll go with the lowest MER. And then finally, let's choose performance. So I'm going to click on the performance tab here and go down to the very bottom for tracking errors. You can see here it measures the dispersion of a portfolio's active return, which is the difference between the portfolio and the benchmark return. So just another criteria we can choose, and let's choose the lowest tracking error. Now there are a ton of other different criteria you can add here. You can just simply click through and see what the criteria means on the far right hand side if you'd like to choose different criteria for your own search. But I only have 91 results here, not including mutual funds, so that seems like enough for me. I'm going to click to view the 91 matches. Once I get here, this is showing me all of the criteria that I've chosen and how these particular funds match that criteria. I can sort of rearrange them based on, for example, now it's showing me lowest to highest MER. I can switch the other way, or name or whatever I would like. I can also click through these tabs and see additional information about these ETFs. Quite a bit of information is available to me. And I can also do a comparison just by simply clicking on whatever 5 ETFs I want to look at. I'm just going to click the top 5 and then I can click compare, and that will take me into a new screen to do some further research there. We're not going to get too far into that today, but just to kind of let you know, there's lots of research that can be done on these ETFs. Once you find them, then you can spend a little bit of time diving a little bit deeper.
And for those in our audience who'd like to learn more about how to build a passive index portfolio, check out our webinar, Why a Few Index Funds Are All My Portfolio Needs. So let's dig into some of those common mistakes then that index investors might actually make that will negatively impact their portfolio's performance. So first mistake we have on the list is trying to time the market. So this is a big one. What does it mean and why might it drag on a portfolio's returns over time?
So timing the market can mean a few different things, but generally It means that someone is trying to buy low, you sell high. But the problem is we never know when low is or when high is. Markets that are high can continue to go higher. Markets that are low can continue to go lower, usually until some point, but we never know when that point might be. And so it's very tempting when markets are falling to panic and to either sell or to hold off on buying, to be hesitant buyers. And when markets are rising, sometimes the same thing can happen. We can be tempted to sell out thinking that this must be near the top, or to think that markets are high right now, maybe I won't buy right now. Or sometimes people get excited by markets going up and they go, yes, markets are going up. They're going to continue to go up. I will buy more than I would normally have bought and overbuy my risk tolerance at this point, and then get into trouble that way. And there's lots and lots of articles you can find out there that say if you miss the top 10 days or the top 20 days of the last year's returns or the last 10 years, and this tends to work over very large time scales too. Missing the top X days of the market return means that you end up getting a very poor or much lower average return over a long period of time, because the market does not go up in a very smooth line. It does not go down in a very smooth line. And sometimes in the middle of these big stock market declines is when we might have those sudden reversal days when the market goes up very sharply. And if you're not invested all the time, you don't capture that long-term average return. So you might attempt to miss a market decline by selling when you think it's high and hoping to buy later when it's low, and might end up being wrong about that. And it doesn't take being wrong very often to end up with a much poorer return.
So how can we, because it's emotional, it's hard, how can we resist the temptation to go ahead and time the market?
Well, a lot of this resisting the temptation business is involved in building good habits and creating a plan and trying to stick to the plan. So if my plan is to invest for the long term, and my plan does not include trying to time the market, then I have to sort of sit on my hands and not time the market. That's a lot easier said than done. When the market is going through some sort of calamity or some sort of euphoria, it's very easy to get caught up in the emotions of the day and to try to anticipate those trends either reversing or continuing on, and thinking, well, I must be smarter than the market, maybe I can do better. But a lot of self-reflection, reminding myself I'm not smarter than the market, I don't have a crystal ball that actually works, and so I have to just stick with my plan. For me, my plan is to invest for the long term and ride those swings up and down. Oftentimes, we'll pull out the plan and look at it and remind myself, this was the plan, I will stick to it. Do a little bit of meditation, try to remind myself, this will get better soon, this too shall pass, and just all of the tricks to get through various uncomfortable periods in our lives. So I'm a big fan of curling. I like to get out on the ice, throw some rocks, be there with my team, sweep and get tired. And I mean, I say that somewhat humorously, but really it's to do anything other than investing and watching the investment news. Whatever trick that you use in your life to not do anything is something to consider.
Okay, the second mistake that we want to consider is letting a portfolio's asset allocation drift too far off target. So what are some potential risks here?
So the big thing is about risks. When we create an asset allocation plan, we're usually doing it with regard to our own risk tolerances. So if I have a certain risk tolerance for, let's say, I'm a pretty risk on investor, I'm pretty comfortable with risk. So let's say that I like having 90% of my holdings in more risky equities. And that's fine. But if I then just let my portfolio sit there, over time it's going to drift. And it might drift so that I end up having 95% equities if the equities are doing much better than the bonds, let's say. And then if I didn't have the risk tolerance for 95 equities in the first place, why should I leave it there? I'm getting a mismatch between my actual allocation and what I said that my risk tolerance was comfortable with. And so if I allow that asset allocation to drift, I'm going to be drifting off of my plan. And I might wake up to a nasty surprise one morning because my allocation is no longer matching my risk tolerance. And so that's what we want to avoid as investors, is avoiding that mismatch between our actual allocation and what we say our risk tolerance is, because we don't want to wake up with that nasty surprise one morning that, oh, we're overexposed to one sector or another that we didn't want to be and we didn't have the risk tolerance for.
Perfect. So it goes back to that understanding what products you're investing in and making sure before you get started.
Yeah, and understanding what your risks are, what your risk tolerance is, and that your risk tolerance probably didn't change just because the market's changed. The time to decide what your risk tolerance is when things are kind of normal. When things are chaotic in the markets or in your own life is usually a bad time to make good decisions about what your long-term risk tolerance is.
Okay, third mistake on your list is what you like to call getting distracted by shiny objects, which I love. What do you mean by that?
So getting distracted by shiny objects is kind of what it sounds like. There's lots of financial news media out there that is constantly barraging us with different investment ideas. And you think to yourself, well, this is an investment opportunity or an investment threat, and I might want to readjust my portfolio accordingly. Well, for most people, that's going to end up being a mistake because it's, again, taking them off of their plan. It may do well, it may not. You can never say for each individual investment, but overall, these shiny objects are deviations from the plan and usually something that we want to avoid. And so there's lots of these things that can crop up, whether it can be cryptocurrencies, disruptive technologies, whatever the theme of the day is. For most people, their plans don't usually include chasing whatever the hot investment of the day is. But it's easy to say that, and then you watch a very compelling argument for one particular investment that is not what you currently have, and maybe the avarice kicks in and you want it. But just because that desire is kicking in doesn't necessarily make it a good investment.
So can you explain a little bit more about what that looks like, what those downsides could be with those hot trending stocks and that people might get caught up in?
Well, the downside is the pretty obvious one, which is what goes up often comes down. Again, not always, but we've heard of a lot of different fads over the decades and decades of stock market investing that have come and gone and come and gone. And we've had many more examples throughout history of people getting over exuberant on the potential, and then when the actual moment arrives for these various companies, these various sectors, these various technologies to produce whatever it is that they had promised, the promise and the reality often falls short of the exuberance that had gotten built up into them. And sometimes the technologies are wonderful. The internet is what we are using right now to communicate. It has indeed become something that has seen mass adoption and wide usage by a large number of people. And if you had invested in a basket of internet stocks in 1998, 1999, you did absolutely terribly as an investor. And that's the big disconnect between some of these investment themes and investment fads and the long-term returns for investors.
Would you say that when people are kind of buying these trends that maybe they're also not doing enough research and maybe not understanding the risks that they're getting into and those sorts of things? Do you think that might be a fair statement?
Absolutely, I would say that's a fair statement. I've seen it, unfortunately, far too many times from people I talk with on message boards, from people I talk with in person who do invest in some of these meme stocks and some of these exuberant sectors, and they find out how little research has been done to get into these sorts of positions. Um, it's a lot of exuberance and not a lot of spreadsheets.
So it goes back again to understanding simplicity, understanding the stocks and investments that you're investing in and making that decision. So just all goes back to the value of simple, Jeff. Okay, but if some investors want to actually actively choose investments in addition to index investing, how can they do this without jeopardizing the success of their investment plan in your view?
So there's a couple of cute names for this, like core and explore, or central and satellite investment portfolios. And basically, the main thing is to think about the behavioral aspects here. So if someone has a desire to have most of their investments in plain, boring index funds that are going to sort of ride out and be untouched, and then have some portion be for more active investing, picking something specific for whatever reason they come up with. If I end up losing money on my core investment, on my explore investments, I don't want to be draining my core to refill it. I don't want to have that become a constant drain. And vice versa, if my risk tolerance says that I should only have a certain portion in my explore, and I happen to do really well, and that explore part gets bigger and bigger compared to my core, I might want to consider pulling some of that back and rebuilding the core. And basically thinking that the money only flows the one way back from the explorer to the core. And if I happen to blow up the explorer, that's a good signal that I should stop doing it. But that's also a very dangerous thing for people, is if they have that explore portion and they happen to do really well. Well, investing is often a mix of luck and skill. And if someone gets lucky early on, they can think that they had skill and mistakenly allocate too much to the explore part going forward. If you have very rigid boundaries around it, it's often a better way to help maintain those rigid boundaries, maintain that explore part within whatever your risk tolerance happens to be.
Okay, let's move to the fourth mistake, which is misusing leverage. So first off, can you unpack what leverage is and how it could be used by an investor?
So leverage is a term of art in the world of investing. It basically means borrowing to invest. So if you have some way to borrow to invest, you can get more leverage. That is, doing a little bit of work gets a much better return. So if I'm borrowing money to invest, so let's say I have $50,000 of my own money and I borrow another $50,000 and my investment doubles. Well, when my investment doubles from that whole 100,000 to 200,000, well, now I've made 150,000 off of my original 50,000. That leverage has given me a magnified return. Unfortunately, it works in the other way too. If my investment drops in half, instead of going from 50,000 to 25,000, I've gone from 50,000 to nothing left, because now my 100,000 combined investment has dropped down to just 50,000, which is the amount I need to have left to pay my original $50,000 loan. And so it's gone. And so that's the big risk with leverage, is that as investments come down on the downside, you can have magnified losses in addition to those improved gains. And sometimes as investments go up and down and they don't necessarily have a nice clean path to a higher point in the future, if they have a period where they go down first and then come back up, if you're levered, you might find that you have what's called a margin call. So if you're using a margin loan from your broker and your collateral goes too low, as we get close to that point where you're running out of money to repay that loan, your brokerage can demand that you sell some of your securities or provide additional capital, additional cash basically, into the account to make sure that that loan still gets paid. And I had that happen to myself during the pandemic. I actually had an argument with my father about this, but long story short, we ended up having it's also a great example of mental accounting, but we had a separate account where he had given me some early inheritance money. So I had said, okay, fine, I'm happy leveraging this, because he thought it was important to learn about using leverage. And of course, the pandemic happens, the stock market crash of March 2020 happens. And just 2 days before the market bottomed, I got the margin call from the broker, had to sell some securities, cover the loan, and then the market almost immediately from there turned around and came back up. If I had just invested the original money into the market and sat on it, it would have gone down. If I had the emotional fortitude to sit on it and then sit on it some more, it would have actually been worth more than what I had originally put in. And instead, it's been a permanent loss of tens of thousands of dollars, because there was that point where, because of the leverage and the market went down enough, that in order to make sure the loan continued to be covered, I had that margin call. There are other ways that investors can get leverage through products that have leverage built in within them. For example, there are many that talk about having 2 or 3 times leverage to the daily move of a particular index or a particular commodity, whatever it is that that product is following. And that daily move part is important because these sound like very attractive products. If I'm a long-term believer in stock market returns, wouldn't I love to have 2 times leveraged long-term stock market returns? But these are not providing 2 times leveraged stock market returns over the long term. They're providing 2 or 3 times leverage returns of the daily moves usually. And so these products suffer from what's called volatility drag, where to help manage those loans and that leverage component, they're rebalancing daily the leverage amounts. And so if the product is going up, or the underlying is going up and down and up and down and up and down, it provides a very different return than if the path is just straight up. And that volatility drag can be a very good reason to give those products a wide berth unless you really know what you're doing with them.
Gotcha. Okay. Again, coming back to the really investing in things you understand and that you can, that are simple, or that you make sure you know what you're doing before you kind of jump in. So, okay, perfect. Okay, we have the last mistake. The one that we'll cover is what you dub letting the tail wag the dog, or in other words, putting too much emphasis on relatively minor considerations. So, what are some examples of how an investor might fall into this behavior with their portfolio?
Well, there's so many that we could do the whole webinar just on this, but a great example is taxes. People are in general averse to having to pay taxes before they have to. And when you sell a security in a non-registered account, there's usually a deemed disposition. So if you have a gain on that, you're usually then going to have to pay capital gains taxes in that year. And so people will generally want to not have to sell that. But if they're in a position where they need to rebalance, quite often rebalancing involves selling the security that's done better to buy the security that's done worse, which means you may be selling at least part of a security that has a gain, which means that you're going to have some capital gains taxes due on that. Again, in non-registered accounts and RSPs and TFSAs, this is all very different. And so people may avoid the rebalancing, which is an important part of sticking to the plan, to save a few, sometimes just a few dollars in taxes on this position. Similarly, when someone is considering switching from actively managed investment products that might have very high fees, or just a high fee product that they don't happen to like at the moment, to something that's lower fee, they may be worried about having to pay the taxes on that, or having to switch and pay some small commission to make that switch happen without considering the long-term impacts on their plan. And usually, if, for example, moving from a high fee fund to a low fee fund can save you so much that worrying about the taxes is in one particular year is not really driving a good decision. And finally, when considering index investing, there are a lot of different indexes out there that look very similar. And people can get really hung up on those very small differences between the different index providers. But they all generally produce a index that is broadly diversified and targets the general market that you want. And so I personally have no brand loyalty. I've looked into the various ones, and I could pick an index fund that tracks an index produced by Selective, by S&P, by MSCI, and I honestly do not care as long as it's a broad market, market cap weighted, plain Jane vanilla index, as long as it's tracking the general geographic region and type of security index or bond or whatever that I'm looking for, I'm usually good with it because they're all so close that it doesn't matter. But if you want to, you could build a spreadsheet and try to track the small percentage differences in each of these, and some people do, and then they end up getting delayed by months or years into actually starting their investment journey because they're trying to pick the perfect product for them, when really there's not that big a difference between any of them. And picking anything that's close to what's appropriate for that particular investor might get them going a lot sooner and actually making progress toward their plan. And they also sometimes forget that they can switch later. If you get the quote unquote wrong, because again, there's not necessarily a ton of difference between these products, get the wrong product for you, you're not locked into it for life. People can switch these products later on as they learn more about themselves, as they refine their plans, or as they learn more about the products.
Okay, John, we're going to have to leave our conversation there. Thank you so much for sharing some common pitfalls of index investing with us. The key takeaway as I see it is that sometimes less can be more when it comes to index investing. Now, before we wrap things up, let's go ahead and answer the trivia question we had a little bit earlier. As a refresher, the question was, according to research by Standard & Poor's, what percentage of actively managed Canadian equity funds underperformed the benchmark S&P TSX Composite Index in the last 10 years between June 30th, 2012 and June 30th, 2022? The answer is Standard & Poor's SPIVA scorecard found that about 82% of actively managed Canadian funds underperformed the benchmark S&P TSX Composite Index during that time. It was a similar dynamic in the US, where roughly 89% of large cap equity funds underperformed the benchmark S&P 500 index. What are your thoughts on that, John?
Well, that's one of the driving reasons to become an index investor rather than investing in actively managed mutual funds, because a large majority of those actively managed mutual funds do underperform their respective indexes over time. And so rather than trying to pick that very tiny percentage that do happen to outperform, which can be a very difficult job, I can pick the easy job of investing in the index and outperforming 80 something percent of those actively managed funds.
Yes, I think that's why there's been such a surge in popularity when those type of results came out in these type of passive investments, for sure. All right. Thank you again for sharing your perspective with us. I really appreciate it. And for those in our audience, make sure to register for upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See y'all next time.